Hi everybody, and welcome back to the Global American Financial YouTube channel. I'm Rodolfo Sierra, and today we'll be talking about why it's important to have a good financial plan. Because remember, if you fail to plan, you have planned to fail. So the idea is we want to make sure that we have a solid financial plan. There's a few key steps on how to do that. We like to say financial plan is like building a home. There's a few basic steps you have to follow. First, you have to plan it, then implement it, and then finally complete it. So for example, when you're building a home, what's the most important part of the structure of that home? Well, of course, it's the foundation. Well, if you don't have a financial plan, you have no foundation for financial growth. For example, when looking at building a financial plan, the most important thing you have to look at first is your insurances, right? So for example, if you don't have the proper homeowner's insurance and your house burns down, that could hurt you financially. Or if you don't have the proper car insurance and you get in a certain car accident and there's some lawsuits, that could hurt you financially as well. So we have to protect what we have first. After there's protection, then we can start managing our debt and mortgage. We can then start looking at emergency funds, having increasing cash flows, having our savings and investments, and ultimately preserving our estate. So what I'm going to do over the next couple of minutes is break down this house and show you why it's an important part of the structure of a financial plan. So for example, we said insurance is important, so proper protection. The most important strategy in a financial plan is protecting your income and your assets. Why use life insurance to build a strong foundation? We just never know in the event of a premature death. Life insurance is vital to the financial survival of any family. For example, you leave behind your spouse, your children, your dreams and goals, your parents. Just the financial amount and emotional burden to them is not worth it. Not only that, but you can also use life insurance for tax savings. You can use it to pass on wealth to your loved ones, and you can also use it for estate planning. So without proper protection, life continues, but at what expense to your family? The next part of a financial plan is managing debt and mortgage. American dream is to pay off your home and be debt free. But the challenge is these mortgage companies, they stack up all the interest at the beginning of your loan, making it really hard to pay off that principal as quickly as you would like. Not only that, but credit card companies do the exact same thing. They stack up all the interest and you're always paying interest first, principal second. So the idea is you want to attack all those principal payments so your interest gets charged less. Now, if that's an opportunity for you guys, we at Global American Financial have the resources to enable you to pay off your debts in as little as 1/3 of half the time, all without changing your lifestyle. It's a proprietary software system. So if you want to learn more about that, please reach out to us. The next part of financial plan is having a good emergency fund. You should at least set aside 3 to 6 months of your income for emergency expenses because you never know what's going to happen, right? You could have a job interruption, which happens a lot in this day and age. You could have a serious illness hospitalization. The illness may not kill you, but the bills might. The third thing is just investment opportunities. Maybe a positive thing. Maybe somebody comes to you and says, hey, I have a great opportunity for you, I'd like to invest in it. If you have no money saved up, you pass on that opportunity. Or just unexpected expenses, right? So being prepared for emergency expenses before they happen is a critical component to a good financial plan. The next one is increasing cash flows, right? There's a tremendous need to increase our incomes to pay our bills, reduce debts, or even just build a nest egg, right? There's two basic ways we can do that. First, we can manage our expenses. What do you want versus what do you need? I want the 100-screen flat screen TV, or I need to pay myself first. You have to make those priorities as you want to plan for the future and for retirement. Second thing is maybe increase your incomes, right? So if you have if you receive a tax refund, which is right around the time right now since it's tax season, you might want to consider adjusting your W-4 allowances so you can get more income today instead of income at the end of the year with the tax refund. Because at the end of the day, what is a tax refund? Right? It's an interest-free loan that you give the government. They pay back to you with no interest. So get that money today and make that work for you so you can start earning more money off of that. And the final piece is, hey, if you want to make a little part-time income, start working for us part-time. We're always looking for people to join our business so you can make a little side money and continue to increase your incomes. Next thing we're talking about is savings and investments, right? Take a look at how much you need to start saving for retirement. So for example, one thing that we use is our Rule of 72. Now Rule of 72 states if you divide any interest rate by 72, it equals how many times it takes for your money to double. So for example, if you go to a bank, and let's just say they're being extremely generous, and they give you a 4% interest on your money market or CD, which is not true, but for the sake of example, let's just say they do. So we divide 72 by 4, it equals 18. That means your money doubles every 18 years. So if you have $10,000, it doubles to 20,000 18 years, and then 40,000 in 36 years. Now, if we increase that interest rate to 6%, you divide 72 by 6, that means money doubles every 12 years. That same $10,000 doubles to 20,000 in 12, 40,000 in 24, and then $80,000 in 36 years. Let me ask you this. Now go back to that bank and ask them for a credit card. What interest rate is the bank going to charge you then? Probably a lot. Let's just say they're being generous again, they only charge you 12%. So if you divide 72 by 12, that means money doubles every 6 years. So if you have $10,000 balance on your credit card, you don't pay off that debt, and the bank charges you 12%, they start earning interest on that money. So in 6 years, that money doubles to $20,000. In 12 years, doubles to $40,000. In the same 36-year time frame, the banks could make up to $640,000 off of your money. Now that's why banks have the nicest buildings in any downtown city center, because they're generating 12% returns on your money and getting $640,000, but yet only paying you 4% and giving you only $40,000. So the idea is we want to help you transition from the 4 and 6% range to more to the 8, 10, 12% range. Wouldn't that be nice, retirement income? Well, how do we do that? Well, there's different strategies that help us do that. You can always go into the stock market, right? Why do we invest in the stock market? We invest in the stock market because there's upside potential. But at the same time, there's also downside risk as well, right? Make sure I'm following. Okay, perfect. It's there for us. Great. But then what happens is when we go to banks or credit unions, we know our money is safe, but the returns are not that great. So what do? Do we take a risk in the markets, or do we not take a risk at all? Well, luckily there's a third option. It's called indexing. Indexing gives you the upside potential that the markets have to offer with the downside protection. All right, so let's take a look at what indexing, how it really works. And if you've seen some of my other YouTube channels, videos, you've probably seen this before, but I just want to recap because it's such a powerful concept. So indexing, the way it works is, let's just say we have $100,000, okay? And the $100,000 is being invested. You as the viewer are be using this indexing strategy. I, as the presenter, will be using the stock market. All right, so let's take a look here and see how that works. So for example, whenever the markets go up 10%, we both gain $10,000, so we're both $110,000. Now the second year as the market, let's say, it drops 15%. Can that happen? Yes, it can. Has it happened? Absolutely has. So if I'm in the stock market, my money drops from $110,000 down to about $93,000. But you with indexing, you stay at zero, you lose nothing, so you get to keep all $110,000. Third year, market goes up 5%. My money grows from $93,000 to about $98,000. I'm not even back to my initial investment. But you with indexing, you grow your 5% from the 110, so now your money's at $115,000. Now the fourth year, here's where the kicker is. Fourth year, markets go up 20%. That means my money grows from $98,000 to about $117,000. And if you're indexing, you're growing from $115,000 all to $131,000. But the way they're going to do that is they're going to put caps and limitations on how much you can earn on the top end. So if the market goes up 20, you with indexing get capped at 14. Now these caps vary from product and company. So it can be as low as 2% to as high as 17% depending on the programs out there. But the point being is that you never lose. With indexing, you eliminate the red. Your money either stays flat or it grows, stays flat or it grows. So over just a 4-year time frame, you're seeing almost a $14,000 difference. Imagine 5, 10, 15, 30 years down the line, how indexing really help your money accelerate and grow. Don't you want that for your money? Then the final piece of a financial plan is estate preservation. Right? One of the pitfalls of not having a proper estate plan is you expose your family to probate, estate, filing expense, even income tax, right? And your heirs receive what is left. So just don't let a lifetime of success be taken away by taxes, lawyer, unintended heirs. The proper plan to secure your family today as well as after you pass on. Now, just final 2 things I want to share with you guys. Really important numbers here, really important numbers. So we're trying to plan for the future. It's super important we start thinking about how much money am I going to need in retirement, how much or how long do I want that money to last. Here's a little graph that we typically show our clients so you can get an example of what it could look like. The example I'm going to show you here is what we normally see people ask and say, hey, I want to have about $10,000 a month in retirement because we're thinking 20, 30 years online where life gets more expensive. And I want my money to last at least 20 years. Life expectancy is usually 80 to 85 years old. Most people retire at 65. So we want $10,000 a month for about 20 years, looking at about $1.5 million of what needs to be saved up in retirement in your nest egg so they can last you that long. Now, if you don't have that money today, it's okay. That's why we at Global American Financial help you figure out how to get there. But the next step is, if the goal is 1.5, how much I have to pay myself to achieve that goal? Well, that's the most important part, right? Depends on when you start. If you start sooner than later, you don't have to pay yourself as much money. The example we have here today is if you want to save that $1.5 million, let's assume just a 10% return for simple math purposes. You're looking at somebody, say my age, who is 30 years away from retirement, I have to pay myself around $727 a month, assuming a 10% return to achieve that $1.5 million. If I push back my retirement by 5 years, I have to pay myself $441. But if I wait to pay myself another 5 years, I have to pay now $1,200 a month. So the challenge is here determining when is the right time to start paying yourself. Well, my answer always is now, sooner than later, right? Because remember, if you have failed to plan, you have planned to fail. So make sure that you have the proper plan in place. So I'd like to thank you for joining us today on our YouTube channel. Please subscribe to learn more about what we have to offer. Again, thank you so much. Have a great day.